Welcome to TheoTrade. This is Don Kaufman doing the weekend update for this kind of shortened holiday Thanksgiving week. It is November 25th, 2016. And today, like, well, much of the recent sessions, is a continuation of the painful, what I'll now call presidential grind to the upside. And more importantly, what I believe to be a much larger short squeeze to the upside. So here in this kind of weekend update, I'm going to talk about not necessarily what my own directional bias happens to be. However, I am short markets. There's no question about it. I'm short in a market that's grinding higher. And a lot of emails come in and they say, well, how do you know this is a short squeeze? Oh, I don't know. I'm short and I'm definitely feeling squeezed right now. So hence the terminology short squeeze. Nevertheless, the grind to the upside continues. And again, in this kind of weekend update here, more important than me being short or you being long, neither here nor there, I'm going to talk about positioning yourself regardless of your directional bias. And I believe that's one of the most important things that we really can get to is, hey, everybody has their own directional opinions, and that's fine. But in a point in time like this where we've actually moved, and again, I'm going to use the SPX in this particular case, and I'll move over to the Russell as well, but when we move from, let's call it roughly 2080, okay, to 2213, and really exceeded all expectations to the upside. I mean, this is looking more and more like the British exit looked. And the British exit, only look back a few months, we traded from 2000, okay, roughly to what? 2160 again. In this point, the 2080 to 2213, almost hard to say. Markets, though, today, day after Thanksgiving, in a shortened session, grind and halt right at all-time highs. But one of the reasons you see a little bit of a short squeeze going on is if you take a look at trade in a 1 minute, just prior to the open, volume comes out of nowhere and panic buys the market up to, and this is the S&P futures, 22 roughly 12 over here. So, and this is some heavy volume for what is, again, kind of a holiday trading session. So, all right, let's kind of cut to the chase and talk about positioning yourself at this point in time. And I think that's one of the most important things, again, we can get to over here is positioning yourself. So we've run up, okay, umpteen points over here in the S&Ps, whatever you want to call it. It's a wild, rally nobody saw coming. I mean, come on, we were all told 3 weeks ago, if X candidate wins, markets are going to tank by 8 to 10%. You had individuals coming out, it's going to crash markets. Right, the exact opposite happens. Again, neither here nor there. The question is, what do you look like right now? First thing you always ask yourself is, am I comfortable with my positions? Now, again, I make no two ways about this. I happen to be short markets up here. And when markets dipped, okay, I did cover some of my risk. And I covered some of my risk literally, okay, on the election evening. I covered NASDAQ future. I covered some S&P future. We explode higher. Now, I've re-upped my position. And I'm sitting right now in the neighborhood. And I don't mind explaining my position. You don't have to, again, mirror the position, but I don't mind explaining my position because I'm short about 6,000, okay, SPY deltas. And what that is equivalent of, it's the equivalent of being short 6,000 shares, okay, of the spiders. And most people look at that and go, oh, how could you sustain that? Well, first of all, I was only short on most of this up move, anywhere from 4,500 to about 5,000 spider deltas. But now I re-upped and I shorted a bit more this week, okay, taking me to a net short position of 6,000 deltas. Now, what's important about, number one, being short markets over here is you have to be able to sustain risk. You can't get squeezed out of a marketplace. As we grind higher, I have to sit back and I have to assume to myself, well, we could trade from 2,200 maybe to 2,300. And then you just ask yourself, like, listen, well, you now know my position, okay? Don is short 6,000 deltas, okay? If we grind another 100 points higher, What's his risk going to be? Well, we'll do this on a very linear basis. Well, 100 points higher, but 100 points in the SPX is a $10 move in the spiders. And I'm short equivalent of 6,000 spiders. It's going to cost me the equivalent of about $60,000. Plain and simple. It's going to cost me 60 grand. Now, for some people, it's a lot. Okay. For me, it's a very, well, I wouldn't say nominal position, but it's a very comfortable position. And again, the amount of capital that you use is up to you. Is this going to be like, life-threatening to me? No, not even close. 60 grand. Okay. Again, that's all up to you is how much risk. And again, I never tell you how much risk to take. You have to decide what you want your risk to be. But here's the overriding theme of a move like this. And this is really what I wanted to get to kind of in the weekend update. Right now in this marketplace, you have to think about risk reward. And I talk about this all the time when markets are at all-time highs. So let's think about risk reward. And to do that, let's just go to a 10-year monthly. All right. And you stop sometimes. And, I said this back when the markets was at 2150. And you're like, but they ground a little bit higher. Yeah, a little bit higher. But you have to recognize something here. All right. And I legitimately did a session back here when we were at 2150 talking about risk reward. And here we are at, 2213. But again, all right, if you take a look back and whether you want to come into, here we are, this is 2015. Ask yourself if you're going to be short. First of all, we'll start with the shorts. If you're going to be short, what's the upside risk versus the downside potential? And it's something, again, that I cover. And if you feel this is like, this is a little bit of a repeat, it should be. It should be repetitive. But you need to ask yourself this question is, even if we were back here at 2150, what's that upside? Ooh, we're going to grind higher, okay, versus the possibility of downside. And the answer is really, really clear now looking back. All right, so even if I did a session back here and we're at 2150, it's the end of the world, okay? It's a very simple answer. And at this point, I feel the same way. And what's that answer? The upside potential is extremely limited versus the downside risks. It was evident back here in the 2120 range. It was evident when we hit 2150, and it's still evident right now at what? 2213. You've seen the downside risks. Listen, since 2015, all right, I've been short. I've been short for years before that. It's because these down moves, what I ultimately do very, very often is I'm short, okay? We move down, I either sell some out of the money premium, collect a lot of juice, or I cover some of the short positions, okay? We've had a number and a multitude of large moves down. Again, the beginning of this year was wild. We're all the way down at 1800. So just being short, I'm not sitting there and being like, not doing nothing. Come on, we traded from 2100 to 1800. I covered a lot of my risk. Then we come back up here. What do you think I do? I re-up. Why? Why do I re-up over here? Even though I was wrong, it doesn't matter. I shorted at 2100. I'm going to be just fine because I can sustain the risk of a 100-point move. Okay? There's one thing you got to remember. If you're going to be short right now, you should be screaming in your head, duration over direction. You know what that means? It means if you can't take the heat, don't even be in the position. You got to be in a comfortable short position right now. It's the place for me to be, because if I'm going to be short, listen, am I going to be right? Yeah, I'll be right. I'm pretty confident saying that, right? How do you know you're going to be right? The market could grind another 100 points higher. Sure, it could, right? But it'll come back down. Listen, I've seen this movie before. Here's a 3-year chart. I could have shorted right here at 1850. Okay, ridden the market higher over there on a short position, continue to sell premium against those shorts. We dip back down, I cover, I'm still ahead of the game. We do it again, I'm still ahead of the game. Now, again, the opportunity over here for me to be short, right? I've got a lot of risk on, great, but I can sustain the risk to the upside. So again, be thinking of yourself of this phrase, duration over direction. And that's a commonly used phrase in this business, and all it means is if whatever position you're going to be in, right? Duration over direction means you have to be able to sustain the position long enough, right? For the directional play to play out. And the directional play, if you're short over here, is, okay, to me, this is very evident that it's a short squeeze. And if you don't believe it in the SPX, go look at the IWM. The IWM is the Russell. And it's the Russell futures now that I've gotten short. So I looked at every product that I felt was overbought, and nothing screamed to me more than the Russell futures. And so I actually shorted a Russell futures. And for those of you that know this product, this is a big trade. One Russell future, every point that it moves, you make or lose $100. Although they're going to split the Russell future very soon, so that every point that it moves, you're going to make or lose. By the way, split, they're not actually going to split it from a $1,300 product. They're actually going to split the contract multiplier of the Russell future. It's only going to be worth $50. Nevertheless, right now it's worth, again, $100 per point move over there. So I just shorted it. Okay, so I'm discussing my own short position. But here's something I want to really resonate with you. If you're short, be thinking duration over direction. If you're long, be thinking nimble. Nimble and defined risk. I can't think of a better phrase to describe it. I'm not going to persuade you, join the dark side of the force over here. I'm not here to persuade you because, market technicians constantly point out, like I'll show you some technical analysis here really quick, because it's one of the things, like if you're into technicals, that's fine. I don't mind, digging into some technicals for you. So this is an RSI Laguerre. We call it the RSI Lahair, or the RSI Doc Severson ain't got no hair, whatever works for you. Anyway, you can see it's in massively overbought territory. The fractal energy is down. Now, this would indicate get short, get short, get short. We're totally overbought. I'm neither here nor there with that one. Because I'll tell you what, I can actually go back in time and I can show you areas that we were overbought for even longer than this with low fractal energy. It was right back here. Oh, guess what? That was July. And we did grind a little bit higher, and then we sold off pretty good, right? And we continued to sell off for a period of time. So it's not wrong. It was just early. Seriously, right? Right here. I mean, I don't have to go back. Listen, it's not wrong. It was just very, very early. So if you were short, you had to have what? Duration over direction. If you're long right now, though, I urge you this idea. If you're long markets, and when I say long markets, I don't care if you own some Apple stock. I don't care if you own some Google. I don't care if you own Caterpillar. And Caterpillar's had this explosive run to the upside. If you're long, be nimble and be defined. What that means is this. If you're long stock in a marketplace at all-time highs, okay, you're going to get what you pay for. And that is, you're going to get the highest risk position in your life. I mean, the way of thinking a market at an all-time high, you now own a marketplace, okay, at a price point that it's never been to before. And the other way to think of this is when you own a market at an all-time high. When I say own the market, you could own any stock you want. I mean, there's some deals out there. I'm sure there's a couple of deals, but you own any stock you want. You're taking more risk than anybody in the known universe has ever taken. You're taking more risk than anybody has ever taken before. How do I know that? Well, because the market's never traded this level before. I'm pretty comfortable in saying, well, the Dow's over 19,000. So you're taking more risk than anyone in the history of markets. So at all-time highs, it doesn't matter if it continues to grind to an all-time high. You have to be nimble and be defined risk. What that means is if you want to get long markets, people use spreads. Use an in-out spread, okay? And I can go into 100 different products over here. And again, I'm actually bearish inside of Caterpillar. I'm bearish inside of Caterpillar, but I want to show this as a bullish trade just so you understand if you're bullish. When I say use defined risk, it means use some type of spread. Spread the risk off. Here's a $2 wide spread for $1. If you're going to be wrong for $1. And when I say be nimble, if you're long right now, you better be ready to reverse the position and get the heck out of things before this market turns against you, okay? Again, think of markets at all-time high as some of the largest risk you ever going to take. And that's, to me, it's always the best reference point to markets at all-time high. So now I'm going to go back on a 3-year again. What's kind of funny is on a 3-year weekly, the RSI isn't necessarily in completely overbought territory. But then you go all the way out to like a 10-year monthly, it is in overbought territory. So the larger time frame is supposed to trump the smaller time frame, yada, yada, yada. That's why I don't look at technicals over here. But, okay, I offer you this, all right? In the IWM, we are squeezing to the upside on what is amounted to some very ridiculous amounts of volume in a product that's usually relatively docile. It's one of the telltale signals, if you will, of a marketplace that's literally squeezing to the upside. You can see even in the IWM, the volume extremely high relative to even previous large moves in the marketplace. Now, another area I do want to talk about over here happens to deal with the TLT. So earlier this week, we positioned ourselves into a long trade in the TLT, looking for a bond bounce. For those of you that are unaware of what's occurred in the bonds as of late, the bonds, they've gotten whacked back pretty hard over here. I'm looking for a very simple bounce trade. Now, when you're looking for a bounce trade, listen, in markets, you're never going to catch a top, you're never going to catch a bottom. I'm long bonds right now, and I'm using a defined risk spread. I'm using they're 35 days out. It's a 120 half, 122 half, okay? It's a spread. We paid about 95 cents for that particular spread. And, options, why did I pick 35 days out? Well, first of all, you can see our open interest in here. Pick 35 days out because even though it's a bounce trade, I wanted to give ourselves enough time to be right. Because when you're trying to pick a bottom to a marketplace and look for the bounce, you're never going to pick it perfectly over there. All right. Last but not least in this kind of weekend update. So again, the overriding theme is Don is short. Now, that's not the overriding theme. I've been short for a very, very long time. Okay. And it's working, and I cover, and we, markets, go to new all-time highs, and then, great, I re-up and I get more short. But again, the big theme is duration over direction, which ultimately means if you're going to be short, you have to be able to sustain pain. The other theme is if you're going to be long, be nimble, be defined risk, okay? And you better be solvent, because these markets can move against you very, very quickly into the downside, right? Just as fast as we're squeezing to the upside, markets can move against you. Now, there's one area of the marketplace that we're going to be watching in recent weeks. This has caught my attention, and it's becoming a much more, detrimental, if you will, theme in the markets, and that is the movement inside of the dollar. You could look towards the presidential election, neither here nor there, but this move really started in kind of early October, late September. The dollar's now moved from 95 all the way to the 102 level. Multiple year highs over here. You have to go back, even if you go back 10-year monthly, doesn't do it justice. I mean, you actually have to bring up a 20-year weekly chart to see the dollar rising to levels similarly to, again, you got to go all the way back. And in this neighborhood, here we are in, 2001, 2002 time frame since the dollar has been at these levels. And this is a very different marketplace back here, given the fact that, again, the dollar, different product, different interest rate environment. As the dollar was rallying the last time, interest rates were also rising at that point. They were being raised in this neighborhood. This is actually the area of the NASDAQ crash in here. Nevertheless, one of the areas that's kind of disconcerting to me is the recent rise in the dollar. Why? Because traders are getting out of bonds, right? Some of the money is flowing back to the S&Ps, but the amount of capital it takes to move the dollar to these levels, I mean, we're talking hundreds of billions of dollars of liquidity. All right, it's actually, in fact, even trillions of dollars of liquidity moving from markets like the yen, moving from markets like the euro. I mean, the euro and the dollar are likely to be at par with each other very soon. That is, a one-for-one kind of relationship out there. Nevertheless, the reason I am looking at this, and I'm a little bit perplexed still by the dollar trade, is this a fear trade? The question is, why are they moving into the dollar with, furious trade out there? It's like, you just can't get enough dollar. It's not likely that this is a short squeeze to the upside over here. They're moving to the dollar for a reason. Okay. One of the things, though, that comes to mind is a stronger dollar. This ain't exactly good for American business that receives 50% of its profitability in the S&P 500 from overseas companies. Now, nobody seems to be talking about the fact that a strong dollar can rip a hole in the U.S. economy. Nope, nobody's worried about that whatsoever. All right. What I'm more concerned about is I want to know why everybody from every, area in this planet is dumping capital into the dollar. Again, is it a fear trade at this point? I mean, if you're scared, you don't go to the yen. You definitely go, the yuan, which is the Chinese dollar. You're not going over to the euro because they got all kinds of problems over there. Where are you going to go? You're going to go to the U.S. dollar. Has the dollar become the new VIX? Okay. And that's something that we really have to start to question. And again, it's kind of perplexing. To me, the level of risk in the S&P 500 isn't really denoting much of anything right now. However, I'm watching the dollar trade in here and believing that this right now might be a sign of pending risk. Now, whatever you want to look at it, could it be traders buying up the dollar like crazy because they're trying to hedge the risk? The answer is yes, it could be. All right. But even if that's not true, the strength in the dollar could still dampen earnings drastically and have negative impacts to the S&P 500. Again, why isn't anybody really talking about that? I don't know. Either way you look at this, all right, a continuation of an up move in the dollar can have detrimental effects to the overall U.S. economy and, more importantly, the S&P 500. In addition to that, we'll be watching the bonds really carefully in the days to come. I mean, like literally this next week. Forget about the Fed. There's almost a 100% chance they're going to raise the rate. Forget about it. It's already priced in over here. But in bonds, very careful. If the bonds continue to slip to the downside, at what point does this fast increase in interest rates, and this is the TNX, at what point does this go from wonderful for the banks to scary? Because a rise in interest rates is typically very, very bullish for the banking sector, but an explosion to the upside in interest rates can be absolutely detrimental. And I think we're right at the inflection point, and I'm going to call it in the bonds over here. If you look at the bonds, the 150 level. If we breach under the 150 level, okay, you might get some more turmoil in the marketplace. And I think if we breach under the 150 level, they're going to go run and they're going to buy the dollar. And that's when you may see the S&Ps break over here. Again, the risk in markets, yes, we're grinding higher, but the largest risk to me is undoubtedly looking at the downside over here. I mean, if you think about it this way, you're now standing on the tallest building pretty much in the world at this point. We've never traded at these levels, right? The risk is we actually fall from these levels. Okay? You're not seeing much volatility, but at the same time, you're seeing monumental moves in products like bonds. You're seeing monumental shifts in products like the dollar. Those alone have got me feeling the fear. And enough traders start looking at this stuff, and we're going to see just that. With that, this coming week, you're going to be looking at me. I'm going to be doing some volatility type trades. Hey, listen, the VIX is low, and I've been looking at, buying some volatility out there. The opportunity, it'll present itself. But this coming week, we're going to hop on some volatility trades into the January. So stay tuned for that. Thanks, everybody, for joining us here on the Weekend Update at TheoTrade. Enjoy kind of the holiday weekend here, and see everybody all throughout next week in the TheoTrade chat room. Have a great weekend. Bye-bye.